The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you. Hey, welcome back to the latest podcast from JamisonMoneyFarmer. This is the JMF Advisors Show. Today, I've got Carl Jamison in the studio with me today. Welcome.
Good to be back.
It's always good. We've done a couple of these. It's always fun to
they are.
Sit in here with Carl. And we've also got a special guest from Founders Advisors Group, Zane Tarence. Zane, I appreciate you joining us and glad you're with us. I mean, one of the things I love about your story is that you're an owner-operator to begin with. You have sold multiple businesses and are now on the investment banking side really helping guide companies that are looking to sell through that sales process. Very experienced founder and now investment banker. Also an author of a book really for people that are looking, business owners that are looking to sell their business. The name of that book is 17 Reasons Your Company is Not Investment Grade and What to Do About It. So we'll have a link to that in the show notes. Very glad to have you today, Zane.
Bobby and Carl, it is super to be with you. Really looking forward to our conversation today.
Hey, Zane, thanks a lot for being on the podcast today. We're really excited to get your perspective and really your insights on for business owners that are thinking about selling their companies. We know that Founders Advisors focuses on a long-term relationship with business owners, similar to the way we are at JMF. And as a result, we both have opportunities to talk with our clients long before they may even contemplate selling. So with that in mind, from your perspective, what are the things that a business owner needs to work on the most if they're on, say, a 5-year exit time horizon?
Great question. And I love what you said, Carl. We believe this is a long-term proposition. We find out in this situation, if you're in a hurry to get a liquidity event as a business owner, it's probably not a good situation. It's probably something to do with a partner disagreement, maybe, God forbid, a health issue or a divorce. What we like to do is plan for it, be super intentional. And so that preparation can add so much value. And to your specific question, Carl, I would say there are several factors that are absolutely critical. And what I tell owners is work on what your ultimate buyer is going to want you to work. So let's talk about that. I would say probably number one is just a professionalized, adept, functional management team. Y'all, you'd be so surprised. Y'all wouldn't, because y'all have a lot of business owners. The number of business owners and teams that are just dysfunctional. They're not able to have candid conversations. They're not able to hold each other accountable without getting defensive, right? And maybe, when they make decisions, ask the question, what is best for our company? Not what's best for a particular shareholder. What's best for our company? Institutional buyers and investors will back off so fast if they see that your management team is not functional, doesn't have a healthy self-awareness, because that can kill a company. And these institutional investors know that. So they're looking for functional, adept management teams. If I've heard it once, I've heard it 100 times. Buyers invest on the jockey, the team, more than they do the horse. So I'd say, first of all, have a adept, powerful management team. And you can get people to help you figure out, are you functional? Are you healthy? You don't have to be perfect. No perfect management team, but are you healthy? So that would probably be the first thing, because most of these investors and buyers, as you know, they're not looking to come in and get rid of everybody.
Right.
They're looking to invest in the current management team, or if there's a younger management team, if somebody wants to get out that's at retirement age, they're looking to deploy capital with a management team. So that's number one.
Yeah, and I guess
Now,
along that line, you sit there and you think, well, this company's just successful in spite of a non-functioning management team, right? And how successful could they be if they had one that was really effective?
that is exactly right. And they'll look at that, but they really don't want to come in, Carl, as you know, and have to bring in a new CEO or a new COO. That's so disruptive to the chemistry. They want to bet on that team, bet on that team's growth strategy, and say, what can we do to give you additional capital, really to execute on your strategy? And so that's key. Now I got to hit one other. We're seeing more and more investors and buyers really look at when it comes to the leaders. They're looking at some indexes that basically are self-awareness indexes. I find this so interesting. You know, these are folks that went to Harvard and Wharton. You would think all they want to see is the numbers. They really want to understand, is the leadership self-aware? Are they humble? That's some of the things these investors are looking at. So I would say a wonderful management team is just critical. And it's okay if you have some gaps. Right. We work with some companies sometimes, and they say, you know, I have a little bit of a gap right now with my financial talent. I think I've over-titled my financial talent. I wished I had a CFO, but I probably have a controller. Mm-hmm. That's okay.
We see that a lot too.
Just be aware of that. Yeah, just be aware that there might be some places where my company has outgrown some really good people. And you can be candid and honest about that. And investors like that because they know you're self-aware.
Yep. Good point.
Yep.
Okay, I've got another one right behind that one, guys. And you're going to say, thank you, Captain Obvious, for bringing this one to us. You'd be amazed at how many times this hurts us. Early on, I would say, really look hard at your revenue centers. Look at your different cash flows, because all cash flow is not created equal. All revenue is not created equal. A lot of entrepreneurs think, oh, what's my multiple of EBITDA? And I'll look at them like this, say, oh, good, I'm going to have a multiple of revenue. Like, I got a multiple of gross margin. None of the above. It's a blended multiple of EBITDA, revenue, or gross margin, but certain revenue streams trade for a lot more than others. I like to kind of draw out a continuum when I have a whiteboard. And on one end of the continuum, that would be a 0 up to 10. A 0 would be one-time revenue. Right. It's okay. One-time revenue is okay. In the business I'm in as a banker, we get success fees. And how many times do owners usually sell their companies? Maybe once or twice their whole life. If they do a recap, maybe twice. So we have some lumpy revenue streams. Guess what? That's not worth that much money to a buyer. If you're a contractor, one-time revenue streams, project-based work, that revenue, that EBITDA is not worth as high a multiple. Now, you move down the continuum a little bit, you get to what we call reoccurring revenue. It happens again, might not be contracted like recurring revenue, okay? Recurring revenue is the cat's meat. Yeah, that happens the first of every month, like a rent payment, like a subscription-based service, like a Netflix subscription, Spotify, that car wash that's trying to sell you a subscription service every day. Why are they trying to sell you a subscription? Because they're owned by a private equity group. And they know that subscription revenue, EBITDA, is going to trade for about 15, 16 times EBITDA. And Joe that comes through the car wash every now and then, that one-time revenue it's reoccurring, might happen again. That's worth maybe 8 times revenue. And then somebody that comes through only once a year, that's not worth anything. So can I say the second thing, management team, but then really look at your income streams. Get some of your smartest people in your company thinking about, how can I move a one-time fee, a project-based fee, more toward reoccurring where it'll happen again. And then if you have some things that happen again, What if you could get some kind of subscription to every month? It's mailbox money. And what I just said sounds simple, but that's the first thing that private equity groups do when they invest in a lot of our clients. They've looked at that analysis of their cash flows, and they get strategies to move those things to the right. So cash flow reoccurring.
That's true in our business.
Yeah.
We have project work and recurring work.
Yep.
The more we have on the recurring side, the better off we are. Same's true in our industry.
Hey, Bobby, can I hit one thing on that too in your industry? Y'all's industry trades for a lot more than ours because of that wonderful fee-based, fiduciary-based revenue that just happens based on, your AUM. But some of your one-time revenue probably is really good consulting and helping me figure out my plan. It might be one time, but if it leads to me putting a lot of money with you under management, that one-time revenue, you have to give it credit for teeing up that recurring revenue. So I don't want companies to despise their project revenue, but make sure you understand the relationship it has to you bringing on recurring revenue.
Yep, that makes sense.
I mean, that kind of goes back to the comment we had earlier on, we're long-term investors in relationships with our clients, just like you guys are. So really having those conversations around ways to move that. And the project work really does. Sometimes that project work is when you're in the heat of the battle, so to speak, on something, and really get you into a good relationship spot for longer term things.
Yep, agree. Zane, anything else?
Well, I wrote this silly book that Bob talked about. I had 17 of these reasons that a company's not investment grade and what to do about it. And I'm really thinking about some of those, Carl and Bobby, that I see most often be the differentiators. I mean, be the things that just catapult you from your industry trading at 7 times multiple of EBITDA to at 10 times. What are those things? Or very often, I see companies that are untradeable because of few things they just don't do well. So let me tell you another one of those things that can make you untradeable. If you have too much customer concentration. This sounds like common sense, but so many clients that we work with, prospects, business owners, they don't realize that they have customer concentration compared to their industry. This is real important with all these factors. Compare yourself against your industry cohort. You guys would need to compare yourself against other, wealth managers, RIAs. We would need to compare ourselves against other investment banks. If you're a contractor, specialty contractor, compare yourselves against other specialty contractors. But let me tell you, a lot of owners have so much customer concentration. And in certain industries, if you sell to enterprises, let's say you distribute valves, you're a valve distributor, and you list out your top 10 customers. I got General Mills, I got Southern Company. What percentage of your revenue are those top 10? If those top 10, I know this because we just did a business in this sector. If those top 10 customers are more than 38%, 38% of your revenue, the buyer is going to see what they hate: risk. They hate risk. What if one of those clients left you? What if the person retired that you had a relationship with? That really hurts you. So what you want to do is look at what your industry average is with customer concentration. And it's usually measured, list out your top 10 customers, what percentage of revenue. You can really find that, you can ask OpenAI, ChatGPT, what is the customer concentration factor in my industry? It'll give it to you. So for instance, if you're a defense contractor, my goodness, there's only 6 customers, right? So it's probably going to be your top 2 customers not being more than 75% of your business. But I will tell you, there's some amazing businesses that we look at. I was looking at one about a year ago, amazing business, making about $8 million in EBITDA a year. We got to their customer concentration, y'all, untradeable. And
Really?
we had to give the advice to them: keep the business, milk that money out and give that money to Carl and Bobby and let them invest it for you, because you shouldn't be investing it in your business, because this is an untradeable business. Buy apartment complexes with that cash flow, give it to your wealth manager, because it's untradeable. Now, is that something they can work on? Yes.
Yep.
Over a 3-year period, you build your compensation plan to where you pay bonuses for new accounts so you can lessen the customer concentration of that one customer. So anyway, that's just another thing that I've seen disqualify families, business owners that thought, I have a 50, 60, $80 million business. And at the end of the day, no, you have a business that is untradeable because of customer concentration.
That's another good example of if you have a 5-year horizon in mind for an exit, that you have time. If you have the discussion at year 1, you have time to start going, how do I de-risk that credit concentration risk, and get to, maybe it takes 7 years, but you set forth a plan over 5 or 7 years to make you go from untradeable to tradable.
Yeah, and that's easier said than done in some industries. Depends, right? I mean,
it depends. And like Bobby said, though, you might unlock $60 million that you have in a untradeable asset. If you can do that, you've unlocked $50, $60 million in value in this family's sake. Now, let me give you another hack. Carl, you said in some situations it's very difficult. We have had clients acquire themselves out of this. If you could go acquire a competitor or an adjacent with a lot more customers, that number 1 customer that you had might turn into your number 6 customer. So you have more customers to spread that risk across. And now all of a sudden, by one acquisition, you unlock your liquidity.
Yep. That's interesting.
Yeah.
Let's talk about, Zane, the financial side of at least the records that your company may provide. We've had clients over the years, have audits, reviews, compilations, now prepared statements. We've had clients, I think, see the benefit of audited statements, even though they weren't required to have them from a, financial institution didn't require it, regulatory body didn't require it, but they knew the value of it because they were thinking ahead on exit strategy, and they thought that they would recoup that investment in an audit, because they're more expensive than the others for sure, because there's more assurance on an audit. So what do you see as far as companies' records and how that might affect values or tradability or anything?
Great question. Huge. And we see there are so many $100 million companies that are out there that their financials are just in disarray. And I actually have some on my whiteboard. I'm going to look at the camera now. I like looking at y'all. I want to read this. I love that question. A set of organized, accurate, and believable financial statements will have more influence on a buyer than anything you say, do, or promise. Carl,
we may have to put that in as a clip or something.
Yeah, I like that.
Yeah. Hey, and guys, I put this on my whiteboard, and when it really gets holy, I laminate. Okay, I laminate this baby, and I start giving it to our clients. Any investment you make in financial reporting and truly becoming GAAP. So many people say, "Oh, we're GAPs, Zane." We start looking at their financials; they're GAAP-ish. They have really not. They've really not said, "Here are my expenses, and here are my revenues per period." Right? Any investor or buyer that's sophisticated, that's going to really pay up, it's going to buy a nice size company, they're going to have to get your financials into GAAP before they can even bid. So that time, that energy to collect data, to be squared away, to close the books on time, to make sure you don't have so many adjustments at the end of every year, the buyer's going, "I can't make sense of this." You're living out of your business. Is this a lifestyle business or is it a growth equity business? So organized financials are critical, and also other KPIs to really look and see the true health of a company. You need the financials accurate by period, but you also need the operational metrics against those financials. You need to know your revenue in our business per MD. You need to know in a SaaS business what's your net and gross retention. You need to know what your average revenue is per rep. Mm-hmm. And if you don't have good data, sophisticated investors throw up their hands and they just say, hey, we don't think we're interested. Really what they're saying is, I am so confused by your financials, I cannot make you a convicted bid. And so it is worth working on your financials. And a lot of entrepreneurs, and I was guilty, guys, it's all about the tax. I'm just going to send my stuff to my accountant, just keep me out of jail, but be very aggressive on my taxes, right? Your financials are a competitive enterprise value creating vehicle. So plan on it. Keep the data. One of the mantras of investors is, in God we trust, all others bring data. And if you don't have good data, you can be the best salesperson in the world. They're going to go. Your financials don't square up.
Well, that's important for me to hear that from somebody like you, because when we try to tell our clients that, sometimes it comes across as self-serving, right, because they think we're just trying to get more fees by upping their engagement. So, yeah.
Yeah, I mean, as a CPA firm, it is a validation really of some of the things we talk about with those folks that have made the decision. We're going into a process for an exit. Even if you mentioned the year-end adjustments things, once you get to where, hey, you're going to provide financial data to a buyer, they don't want annual financials. They want monthly or quarterly financials. So at some point, you've got to go back to those year-end adjustments and layer them through, the 12 months to look at, because they're trying to figure out operational trends, seasonality, you name it, to really get a good handle on what business that they are acquiring and what are the things that they need to do to sort of ramp up the operation.
100%. And Bobby, you made a point. And my new book is called, that I'm writing, Don't Start a Business. Buy one and make it better. And when I've watched people that do this, that buy companies, grow them like crazy with the team and just create incredible enterprise value, the focus on the financials immediately goes up. They upgrade their financial people. They upgrade their advisors. They do audits. They do quality of earnings. Mm-hmm. Listen, if I found a company I liked, said, Zane, I want you to buy this company and make it better. You got $1 million to spend over the next year. I would spend it, first of all, I would look at the financial system and processes. I would upgrade that because I know what kind of enterprise value that adds. That's like adding to a residential house a big closet nowadays. It's like adding an unbelievable kitchen, okay? Every dollar you spend is going to make you 10 more dollars. So being naturally bright like I am, watching this over the last 25 years, the best investors in the world spend the money to upgrade the financial quality of that firm, period. So I would say in preparation, do that prior to getting ready for a sale. You will get back 10 times or more on your money. And guess what else you'll have? If you keep the business, you'll have a lot better data by which to run your business. So I love that one. Spend time on it. And I said earlier, a lot of people over-title their financial people. Mm-hmm. Be honest. Let outsiders like y'all come in and advise them and say, no. And I had a person today, yeah, you're right. I don't have a CFO. I have a controller. I said, I got bad news.
You got a bookkeeper.
You got a bookkeeper. Yeah. That's right. So
we've
anyway,
seen that too.
Financials are boring, but I'll borrow something from Nick Saban. I'm an Auburn guy, so this hurts me to say. But you're only as good as your record says you are. And in business, that's your financials.
Mm-hmm. Good point.
Yeah. You mentioned a couple of trends you're seeing, like particularly with the, the soft skills of the management team things? What are some of those other things you're seeing? Maybe it's in the last 12 months or 2 years from a lot of buyers that, are from a trend perspective that they're putting more interest in or value on for a business owner.
Question. I would say there is a lot more interest. I mean, unbelievable amounts of interest on security, cyber security.
Mm-hmm.
These investors are not going to put money in a business where there has been risk, where there's been even not so much a breach, but even an incident to where you've had some issues with your data. And y'all, this is hard for me to say because I've seen so much wealth just blown out the window in the last stages of a process because of a security incident, to where there's just this risk that some client data might be on the dark web and there's no due diligence that can find that. So what does a buyer do? They back off. The level of security diligence I see nowadays compared to 10 years ago, night and day. So another place to spend your money, do an audit, pay a tiger team to come in and say, really look at us. Please don't find this out in confirmatory due diligence right before you're about to get $80 million. Yeah. Please do that. And when we work with clients early, we go through the due diligence early, way before you ever go out to potential buyers. And that's one of the things we go through. So that's being looked at very heavily. The other thing that I know you're probably familiar with is your net promoter score. This grew out of Harvard. A Harvard professor wrote about it. Mitt Romney purchased it when he was over Bain Capital several years ago, probably a decade ago. And then they ended up commercializing this with McKinsey and other consulting groups. That's the question we always see people ask us at Chick-fil-A or with your banker. How likely are you to recommend founders to a friend or colleague on a scale of 1 to 10? That net promoter score, every institutional investor is looking at your net promoter score compared to your cohort. So you need to test this every year. It's a simple question. That question, 0 to 10. If they do a 0 to 6, they're a detractor. If they say a 7 or 8, they're passive. Okay. Y'all, passives are even worse than detractors. You can fix a detractor. Why did you not like founders? What did they do? If they're a detractor, they know exactly. Tells here's what you did. You didn't ever listen to me. Okay. If they're passive, one thing's good as another. I don't know. They're just the same. If they're a 9 or 10, that's a promoter. If you'll ask 30 of your customers this at least to make it valid, there's a simple way to do it. You don't have to hire McKinsey for $200,000. Ask them this question, track it year over year. You throw out your passes. You take your percentage of your promoters, your 9s and 10, subtract your detractors. That's your net promoter score. Every industry now by NAICS codes has what a good net promoter score and a poor one is. And you can compare yourself against your industry. Buyers look at this because they found out it's the one number that they need to know to predict if you're going to grow or not. If you have a high net promoter score, guess what? Unless your market totally changes, unless you're a blockbuster video, compared to net, you are going to grow. If there's a restaurant in town, they open up and they have a high net promoter score for opening where 9 out of 10 people say, that's the best thing ever. And they go back out in your community, that restaurant's going to grow. If people come out and say, And nowadays we have amplifiers with social media. Everybody is a publisher on the reviews. Everybody is a producer with this camera. Man, look at this food. It's awesome. Put it out on your Instagram.
Yep.
Net promoter score. So security, net promoter score, critical things that are kind of new to the M&A business.
That's very interesting.
We've kind of been talking about, okay, I've decided to sell. Here are the things I need to start doing to position my company to sell for the most amount of money, right?
Yep.
But I'm hearing Zane talk about things that companies, even if they're not thinking about selling, need to be doing every year.
Yeah.
You agree, Zane?
Carl, you can't throw me that softball.
I
I
got
got to
to.
talk about it. I have a lot of people say when I go to speak at associations, they'll say, Zane, you just want me to sell my business soon so you can get a fee. Well, we do like doing transactions, okay? But we want it to be at the right time. But I say this, is there anybody in this room of business owners that doesn't want more cash flow, more peace of mind, and more freedom in their business? I go, no, we want that. I say, well, you're going to love these 17 reasons your company's not investment grade. Because if you do these things, guess what you'll have? More cash flow, a more fun company that you can leave and it just gets better, better, and better. And the journey is more fun. So my passion, Carl, and even when I preach to myself, with Dwayne, my partner, and I and Wes talk about this, it's about let's run an investment grade company, even if we never want to do a deal. And I can tell you in our business, we love our company. We want to transition it to our younger people over time. But they don't want to be a B company. They want an A company. And also, I want them to pay me for an A company, right? I'm not going to give it to them. So yes, do this anyway. Guess what? Makes it easier to recruit talent. Do A players want to come work for a B company that's like, yeah, we're just out here for the fun of it. We're not really trying to grow value. We don't care if we grow compared to our competitors. No, winners want to work for an A company that's investment grade. Makes it easier to buy other companies. You can use your stock because people say, wow, I believe y'all stock's worth something. So I love that question. When people accuse me of just wanting them to sell and get a fee, I'm like, you're wrong. I want you to have optionality. And if you're an investment grade business that really tries to do your best in all these things, guess what? You can keep the business
or you can sell it.
You can sell it. You can do an ESOP. You can give it to your favorite ministry. But I want business owners to think about stewardship. It is my responsibility to be the best we can be, not only for my people, my family, also my customers. Which customers come to you and say, I'm going to beat you up at your price over and over and over? No, they want to do business with an investment grade business that has good security, that has a high net promoter score, that has really good financials, so you can know you can continue to serve them with the best talent possible. So sorry I get so passionate, Carl, but this stuff matters. Yeah.
I mean, you've touched on it, and I don't know that we've used this word, but it's really discipline around running your business. And whether we're talking specifically about the financial components of those things or the softer components, if you're disciplined and intentional about creating value in that business, you are going to have options, whether it is to sell today, sell in 5 years, or never sell. I mean, we're all going to leave the earth at some point, so there's going to be a transition. You just may not be in control of it at that point, but I mean, there will be something there for sure.
Mm-hmm.
That's correct.
So when is your next book due out?
Well, here's the problem. This is probably the hardest thing I've ever done. Well, being married 36 years is probably the hardest thing, okay? It's worth it, right?
Yes.
John Maxwell says everything worthwhile in life is uphill. Second hardest thing I've ever done is try to write a book. So my first one took me about 5 years. I'm doing well on this. My goal is middle of 2025.
Okay.
Because I'm seeing this huge trend of people my age, baby boomers that own, well, y'all probably know more of the numbers than me. I think they own about, of the 12 million private companies that are kind of sized that institutional investors look at in North America, I think about 65% of those are owned by baby boomers. Okay. So there's this huge opportunity not to go start a business. That's too difficult. Go buy a 30-year-old business that has a brand, has customers, has a reputation, good product, but make it better. Mm-hmm. And so I really believe the opportunity, instead of entrepreneurship, going out, well, it's a different form of entrepreneurship. Don't do a startup. Most of those fail. 98% of those fail. Go buy a company, look at all these factors, do due diligence, and say, you know what? I can take this and add capital, add talent, add better culture, and really turn it into something special fast. So I want to get that book out because it's about acquisition entrepreneurship. And I hope I'm about a year out. Carl.
That'd be good. I can't wait to read that one. I've got to read the first one first, though.
Absolutely.
Yeah.
So one of the things that word you mentioned is optionality, which I love that word. There are times when firms are doing a lot of the things that you talked about and are in a good spot from that they're well known in their industry. They're hey, these guys are leaders. You should go take a look at them. And sometimes they'll just they haven't made a decision to go sell or not go through a structured process. None of those things. They just sort of get an offer out of the blue. And I mean, look, sometimes those offers can blow you away, but as the business owner that wasn't thinking about selling, you may not. Is that a good offer? They come to folks like us in the CPA world, or who should we go talk to? What would you say from for those businesses that, hey, I got an offer today, and in today's world you're getting offers quite a bit. So how do you best maximize and capitalize on that?
And we call those in our world, Bobby, preemptive offers. Somebody's seen you and they're saying, hey, we think you could be a really good fit for us. Congratulations on what you built. There's nothing wrong with those, but here's the truth about it. One offer is no offer. You have no basis. If you haven't done the work, the prep, some valuation work, understanding your industry, if you're not making a market, how do you know that they're really paying up? Because a private company is worth whatever a willing buyer is willing to pay. You've got one, but what if you have 4 or 5 that have thesis on how they're going to grow you and why? Maybe some strategic buyers. Man, 1 + 1 would equal 3. We have seen offers that make no financial sense because they do the financial diligence, but then they say, this is the missing piece. Well, our 10,000 customer base, this product. So be very careful on that. They can end up being your best buyer. You don't say, don't give me an offer. You say, listen, I'm very grateful for that offer. We want to be good stewards. We're thinking about this. Let us get really organized. First of all, hopefully you're organized where you can give them the right kind of data to make a convicted offer, right? Otherwise, it's just a guess. They're going to back you up when they put that engagement ring on you and sign you up for due diligence. They can come in, even if they're not bad people, it's their job to say, ooh, this is not quite what we thought it was. We're going to have to lower our offer. So be very careful. One buyer's no buyer. We encourage you to be prepared so that you can talk to several and really get a bit of a market knowledge where the market can speak in a competitive process. And then amazing things happen. Bobby, we've seen those first preemptive offers and even traditional businesses go up 50, 60, 80%. You know why? Because they know they're going to miss out.
Yeah, FOMO.
FOMO. And then you see what their model really tells them you're worth. Their job is to buy you, like I say, they're buying you, they're buying mules. You want to sell a racehorse, right? But they're buying a mule. They're finding everything that's wrong. So there's a lot of people buying and selling companies now. Most good companies are going to get 1 or 2 emails a week from private equity groups or strategics or advisors like us saying, hey, we think we can help you with a deal. I would just say be prepared so that you can get the whole market to confidentially look at you. Here's the other thing. A lot of our clients believe they only have a few potential buyers. They're competitors that they've seen at trade shows for 30 years. Y'all, that's not so. About over 15% of our deals last year were international buyers. Wow, we work with companies 30 million to 200 million. 15%. In 2021, about 20% were international buyers. Okay. There are so many different family offices, search funds, private equity groups that do majority recaps, international funds, strategics, hybrid strategics, publicly traded strategics. You really can't get a bead on what you're worth unless you're prepared with good data and that you can confidentially go out and get multiple bids.
Yeah, so I think my answer to your question, Bobby, was you call Zane or Dwayne or somebody at Founders and get them to help you with that one offer. Whatever fee they're going to charge, they're going to make back tenfold. I mean, these guys know the market, know what your company's worth after they look at it. So selfish plug for Zane, but that's my answer.
Thanks for saying that. In our industry, my dad says, he's a preacher. He said, son, y'all have a little greed in your industry. You need to police your industry better. I said, Dad, you got some problems in your industry too as a pastor. So, be careful. But I don't want people to think sometimes like, okay, I'm trying to sell you. You need a banker. Even if it's not us, get somebody to represent you. Because we typically see those first offers. Guess what? It wasn't their best offer.
Yeah.
And you can often push those up. I mean, in a $30, $50 million business, tens of millions of dollars.
Oh, yeah. You're going to leave money on the table without professional help.
Well,
no doubt.
The things we try to tell clients and folks that ask us is that, if you're a great operator or a great entrepreneur, you're going to sell one business or maybe two businesses in your life. And that would be a fantastic success. But, Zane sees deals all the time. And
that's what they do. Yeah.
So they know they've kind of seen some of the landmines and hurdles and things that, that's not the way we a lot of folks are like, yeah, this is a $50 million offer. Well, it's actually a $25 million offer with a $25 million earnout. That's a completely different thing. So you really have to rely on your folks, professional advisors, to kind of drive you in the right direction, because you're probably only going to sell that business once.
Don't be scared to spend that money.
Yeah.
Because you're going to get it back, my opinion.
Well, thank you, Carl, for that. And that's the way we feel about all professionals. When I was an entrepreneur early, I was scared of the best attorneys.
Yep.
And this is a safe place, right? I'm just going to say like I do. I was really so scared to open up the envelope for my attorney, the invoice, because I was like, and I would try not to call them. My CPAs, I was nervous to do special work and to do these audits because like, man, it's going to cost me a lot of money. My wealth manager, I didn't really need one when I started my company, right? But it's like, wait a second, I can pick my own stocks. And, financial, advisors like us, investment bankers, I'm going to tell you, the more I'm around successful business people, the more I see they get the best advisors in every area. And they will look you in the eye and say it is the best investment they've ever made. I look back at attorneys and CPAs, wealth managers that have helped me be diversified and not just think I can go pick a stock. Say, Zane, go focus on what you're good at. Let us advise you. They will make you more money. And I challenge people all the time. Find me a super successful business person that doesn't surround themselves with advisors and coaches in all different areas of their life. Yep. They submit to it. They want accountability from people that specialize in that area.
Boy, I think that's a great way to. You summed it up pretty well there.
Yeah.
We've certainly enjoyed the visit with you. Love your energy and passion for helping small businesses. Carl and I both also share that passion for helping business owners. So thank you very much for spending some time with us today, and we look forward to reading that new book.
Yes, we do. Let us know.
Well, thank you all so much, and thanks for putting up with my technology at the wrong camera. We're very grateful to y'all for being partners, and thank you for inviting me on today.
Thanks, Zane. Thanks a lot. Bobby, thanks for having me on too.
Yeah, we're glad to be here. Thanks again, Zane, and appreciate it. Everybody, if you could like, subscribe, share any of these podcasts with any business owners that you might be friendly with, that'd be great. We've certainly enjoyed chatting about preparing your business for sale today with Zane. Appreciate it, and y'all have a great day. Thanks.
Thanks.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.